Hello, traders. Gary Wagner here, 11:51 in Honolulu and 5:51 in New York on Monday, 28th day of March, 2022, and this is the daily report for gold and silver. Traders, the precious metals across the board had strong sell-offs today. April gold currently fixed at $1923.30. It's showing a net decline of $16.50. That is comparing it to the close in New York. It's really down about $30 on the day. Dollar strength is partially due to today's decline in the precious metals, but ever so slightly. And you'll see that when we look at spot gold and the Kitco Gold Index. We are looking at the current price of spot or Forex gold at $1,922 and change. Now, I've just put up the Kitco Gold Index, which when I took this screen print, we had spot gold fixed at $1922.60. That's a decline of $35.80. But on closer inspection, dollar strength accounted for $7 of that decline, while selling pressure was directly responsible for a decline of $28.75. Obviously, predominant selling was absolutely the primary cause of gold prices moving lower. Traders, I do want to take a look at areas where we could find potential support, but luckily on Thursday, March the 24th, we sent out a trade alert. I've just put it up on the screen, and it was to raise our stops. On our gold futures position, which is the June contract, we raised that to $19.44. We got in at $19.33, $1,100 in terms of profit on that. On our Forex trade, we raised our stop to $39, but realized we never rolled over Forex because it is spot, so there was more profit on this leg of the trade in Forex. However, there weren't two components to it. Lastly, GLD, we raised our stop to 181.20. When we look at pricing, they are all far below that price, and we are flat with no active trades and having pulled profit. That being said, where can we expect to find a little bit of support? Well, the easiest way, of course, is going to be to do a retracement. I've done two Fib retracement sets, a very long one, which goes back to February, and then a shorter one to cover the last part of this leg. And what I'm looking for is what I call Fibonacci harmonics. Harmonics is when you use two different data sets and you get numbers, even though one is at 50 and one is at 78%, that are fairly close together. And that's exactly what we're getting here. The 50% retracement from the long data set and the 78% retracement from the short data set are approximately $5 apart. And that's why I believe that this is a key and important area. Now, we are trading just at it right now. If, in fact, we get a further decline, we want to look at it in a couple of places. The first place is this bottom right here, comes in at about 1910, and then this particular bottom right here, which comes in below 1900. Those are based, of course, on recent lows that came in the market. We will remain flat. We want confirmation that the market has bottomed, that the Federal Reserve will raise rates much quicker than anticipated, because my feeling is no matter what the Federal Reserve does in terms of how quickly they raise interest rates, it is not going to have a dramatic effect on inflation. It cannot, because the problems are on the supply side and not the demand side. It is for that reason that if we see an uptick, let's say in the report during March 31st, you can expect to see gold move right back into a full-blown rally. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.